Hello, everyone, and a warm welcome to today's session. I'm glad you could join us. Today, we're going to explore an important topic, the Goods and Services Tax, or GST, and its impact on India's economy. Our focus will be on uncovering common myths and facts about GST. We'll also look into how this landmark tax reform has transformed the way India manages taxation. So, stay with me as we break down the key concepts and clear up some misconceptions along the way. Let's get started. Let's talk about what GST is and why it matters. GST, or Goods and Services Tax, was implemented in India starting July 1, 2017. Its main goal was to simplify the complex web of indirect taxes that existed before. Before GST, there were multiple taxes imposed by both the central and state governments, which often made compliance complicated and confusing for businesses and consumers alike. GST replaced all those various taxes with a single, unified system. Think of it as creating one common tax structure across the entire country. This is where the idea of one nation, one tax comes into play. It aims to create a seamless tax environment, making it easier for goods and services to move across states without the hassle of multiple tax payments and paperwork. Overall, GST's introduction was a major step towards streamlining India's indirect tax system, making it more transparent and efficient. It's a key part of the broader goal of building a more integrated and business-friendly economy. All right, let's clear up a common misconception here. Many people believe that all invoices must be created digitally, on a computer or online. But that's actually a myth. The truth is, invoices can still be generated manually, using traditional methods like paper and pen or printed templates. The key point is that the internet is mainly necessary when it comes to filing your monthly GST returns online. So, while digital tools are useful and often required for reporting, they're not a strict requirement for creating your invoices. Understanding this helps us see that businesses have flexibility in how they handle invoicing, and it's important to focus on what's actually mandatory for compliance. This ties into the larger theme of demystifying GST processes and making them more practical for everyday business operations. Now, let's talk about a common myth surrounding internet usage and GST compliance. Many believe that you need to have constant internet connectivity to run your business smoothly under GST regulations. However, this isn't entirely accurate. The truth is, while having internet access is essential for certain tasks, it's not necessary to be connected all the time. The main requirement for GST purposes is to file your monthly GST returns, and that can typically be done at specific times rather than constantly online. So, daily operations, like managing sales, inventory, or customer interactions, do not always demand continuous internet access. It's more about having reliable access when it's time to submit your returns, rather than needing to stay online 24/7. Understanding this helps you focus your resources more effectively, avoiding the misconception that constant connectivity is mandatory. This aligns with our overall theme of dispelling myths and clarifying what's truly necessary for GST compliance. Now, let's clear up a common misconception about the provisional GST ID. Many people believe that the provisional ID they receive is not their final GSTIN. But in reality, that provisional ID is actually your final GST identification number. Once you have your provisional GST ID, it functions as your official GSTIN for all practical purposes. This means you can start using it for your transactions, filings, and compliance. It's important to understand this because it simplifies the process. You don't need to wait for a different number or worry about changes later on. Remember, your provisional ID is essentially your final ID, so treat it as your permanent GST registration number. This understanding is key as we move forward in mastering GST compliance and registration procedures. Now, let's talk about myth 4, the idea that if an item was previously exempt, you need to register immediately. Some people believe that once an exemption changes or ends, you have to act right away to register. But that's actually not the case. The fact is, you can continue doing business with that exempt item without panicking. You're given a window of 30 days to get registered, so there's no need to rush or make hasty decisions. This timeline gives you a comfortable period to plan and ensure you're compliant without disrupting your operations. Remember, understanding this helps you avoid unnecessary stress and keeps your business running smoothly. It's all about knowing your rights and deadlines so you can focus on what matters most, serving your customers and growing your business. Let's clear up a common myth about GST compliance. Many people believe that businesses need to file 3 different returns every month, but that's actually a misconception. In reality, for most businesses, there is primarily just one main return to focus on. The GSTR3B. This return is quite comprehensive. It has 3 sections or parts that need to be filled out. Now, some businesses, especially those with more complex transactions, might have to file additional returns, but the core requirement remains centered around that one GSTR3B. Understanding this helps streamline your compliance process and avoid unnecessary confusion or overcommitment. So, the key takeaway here is not to get overwhelmed by the idea of multiple returns. Instead, focus on the primary return, which is manageable and designed to cover most scenarios. This is just one example of how myths can distort our understanding of GST obligations, and it's important to stay informed so we can comply efficiently and confidently. Now, let's clear up a common misconception. Myth 6. The idea that all businesses, including small dealers, have to file invoice-wise details in their returns. Many believe that no matter the size of the business, detailed invoice reporting is mandatory. But that's actually not the case. For retail businesses operating on a B2C model, meaning selling directly to consumers, the requirement is much simpler. Instead of having to file detailed invoices, these businesses only need to submit a summary of their total sales. This is a significant point because it reduces the compliance burden for small and medium retailers, making the process more manageable. It's important to understand this distinction so that we're not overcomplicating things or assuming that all businesses are subject to the same detailed filing requirements. Understanding this helps us focus on what's truly necessary and ensures we're complying correctly without unnecessary hassle. So remember, the key takeaway is that B2C retail businesses only need to file a summary of their total sales, not every invoice separately. Now let's talk about myth 7, the idea that GST rates are always higher than the earlier VAT rates. Some people believe that since the GST is a new tax, it must be more expensive. But the truth is, this is a misconception. What often appears as a higher rate is actually because, under GST, the various taxes that used to be applied separately, like excise, VAT, and service tax, are now combined and presented as a single rate. This might make it look like the rates have increased, but in reality, the GST is designed to bring transparency. It's about removing what's called the tax on tax, or the cascading effect, where taxes pile up on top of each other, making goods more expensive. So even if the rate looks higher, the overall tax burden can actually be lower or the same, thanks to this simplification and the elimination of hidden taxes. This point is important because it ties into the overall goal of GST, to create a more transparent, fair, and efficient tax system. It helps consumers understand what they're paying for without hidden layers of tax. So, in essence, higher-looking rates don't necessarily mean higher taxes. It's often just a clearer picture of what's included. Now, let's address myth 8, which is the belief that GST applies to agricultural income. Many people think that earning from farming or selling fresh produce is taxed under GST. However, the truth is quite different. GST does not apply to income generated from agricultural activities or the sale of fresh agricultural produce. This exemption is in place to support farmers and ensure that essential food items remain affordable. So, when you're dealing with agricultural income or selling fresh produce directly from the farm, you don't need to worry about GST compliance. Recognizing this exemption helps us understand how GST is designed to target certain sectors while supporting vital agricultural activities. This point ties into our overall theme of clarifying misconceptions about GST and understanding its scope across different income sources. Let's talk about Myth 9, which is the misconception that no input tax credit, or ITC, can be claimed on discounts. Some people think that if a discount is given to a customer, then the ITC can't be claimed on the corresponding invoice. But the truth is, that's not entirely accurate. In reality, if the discount is mentioned directly on the invoice or is linked to a formal agreement, it generally remains eligible for ITC adjustments. What this means is that as long as the discount is properly documented and reflected in your invoicing or agreement, you can still claim the ITC on the amount after the discount. This is an important clarification because many businesses might overlook ITC eligibility when offering discounts, thinking it disqualifies them. So, in the context of our overall theme, understanding the correct treatment of discounts helps ensure compliance and maximizes your eligible credits. It's crucial to remember that proper documentation and transparency are key to claiming ITC accurately on discounted invoices. Now, let's address Myth 10, the idea that GST returns can be revised after they've been filed. Many people believe that once they've submitted their GST return, they can go back and make changes if they spot a mistake. However, that's actually a misconception. In reality, once you filed a GST return, it cannot be revised or amended. If you realize there's an error, the correct approach is to rectify it in the next reporting period by submitting a new return. This means it's crucial to double-check all your information before filing to avoid mistakes. Remember, this rule underscores the importance of accuracy and careful review in your GST compliance process. It's a key point to keep in mind for maintaining proper records and staying compliant with GST regulations. Let's address a common myth about GST, that only large companies can benefit from it. Many people believe that only big players stand to gain, but that's simply not true. In reality, GST benefits businesses of all sizes. It helps by streamlining the tax process, making compliance easier, and reducing the overall tax burden. This creates a level playing field, allowing small and medium-sized businesses to compete more fairly with larger firms. So, regardless of your company's size, GST can be a positive change, making business operations simpler and more efficient for everyone. Now, let's talk about the removal of the cascading effect. Essentially, this was about eliminating what's often called the tax on tax. You can think of it as a situation where taxes get layered on top of each other, which can really inflate the final cost. By removing this cascading effect, we made the tax structure much more straightforward and fair. What this means in practice is that the overall tax burden on the end consumer tends to decrease. When taxes are layered in this way, the final price they pay ends up being higher than it should be. So, by simplifying the process and removing that extra layer, we often see a decrease in the final cost for consumers. This change is important because it aligns with the overall goal of making the tax system more efficient and transparent, ultimately benefiting the end user. It's a clear example of how streamlining tax policies can lead to tangible benefits, like lower prices, that resonate with everyone. Now, let's talk about the creation of a unified national market in India. This was a major milestone because it essentially brought together the entire country into a single, cohesive economic space. By doing so, we eliminated many of the barriers that previously made trade between states complicated and cumbersome. Think of it this way. Before this, each state had its own rules, tariffs, and regulations that often slowed down the movement of goods and services across borders. With the unified market, those barriers were removed, making it easier and more efficient to trade from one state to another. This simplification of interstate trade not only boosted economic activity, but also encouraged businesses to expand and innovate, knowing they could operate across a larger, integrated market. Overall, creating a unified national market has been a key step in strengthening the country's economic framework and ensuring that resources are utilized more effectively across India. Now, let's take a closer look at how transparency and ease of doing business have improved. Increasing transparency in the tax system means that information is clearer and more accessible, which builds trust and confidence among taxpayers. This openness also helps reduce opportunities for tax evasion, making the system fairer for everyone. At the same time, we've simplified compliance processes, cutting down on unnecessary paperwork and making it easier for businesses and individuals to meet their obligations. These steps have directly contributed to India's improved ranking in the Ease of Doing Business Index, signaling a more attractive environment for investment and entrepreneurship. Overall, these reforms are all about creating a more transparent, efficient, and friendly business climate that benefits the economy as a whole. As we look at how technology has shaped this process, it's clear that digital tools have truly been a game changer. From online registration to return filing and e-way bills, these advancements have streamlined what used to be complex and time-consuming tasks. They've made it easier for businesses to comply with regulations and for authorities to manage compliance more effectively. Overall, this technological shift has significantly improved efficiency, reducing manual effort and minimizing errors. It's a perfect example of how innovation can make a big difference in administrative processes, aligning seamlessly with our theme of modernization and better governance. As we look at this slide, what we're seeing is how a strong and reliable IT infrastructure plays a crucial role in boosting our tax base and ensuring compliance. When the technology is robust, it makes it much easier for businesses to register and report their taxes accurately. This, in turn, creates a solid incentive for claiming input tax credits, or ITCs, which encourages more businesses to participate honestly in the system. As more businesses register and comply, we naturally see an increase in the overall tax collection for the government. This is vital because a larger, more compliant tax base provides the resources needed for development and public services. Ultimately, all these points connect back to our goal of creating a fair, transparent, and efficient tax system that supports sustainable growth. Now, let's talk about how these changes benefit consumers directly. One of the main goals is to make goods and services more affordable for everyone. When taxes are structured fairly and transparently, it often leads to lower costs for consumers at the checkout. Additionally, increased transparency regarding taxes paid means consumers can better understand how their money is being used. This clarity helps build trust and confidence in the system, knowing that taxes are being collected and spent responsibly. Overall, these improvements aim to create a more fair and straightforward environment, making it easier for consumers to see the value and purpose behind the taxes they pay. It's all about building a system that works better for everyone, putting more money back into people's pockets and increasing trust in the process. Now, let's take a closer look at the different types of GST and how they function within our tax system. First up, we have CGST, which stands for Central Goods and Services Tax. This is the tax levied by the central government on intrastate transactions, that is, transactions happening within the same state. Think of it as the central government's share when goods and services are traded within a single state. Next, we have SGST and UTGST, which are the State Goods and Services Tax and Union Territory Goods and Services Tax, respectively. These are collected by the state or union territory governments, again on intrastate transactions. Essentially, when a sale occurs within a state or union territory, both the central and the state or UT governments share the tax revenue. Finally, there's the IGST, or Integrated Goods and Services Tax. This one is a bit different because it's applied on interstate transactions. That is, when goods or services move from one state to another, or on imports from other countries. The central government manages this tax, and it helps streamline the process of collecting GST across different states, ensuring there's no double taxation or confusion. Overall, these three types of GST work together to create a unified tax structure that simplifies the process, reduces the tax burden on businesses, and promotes seamless trade across states and borders. Understanding how each type functions is key to grasping the bigger picture of GST's role in our economy. Now, let's take a closer look at the GST rates themselves. The primary slabs are set at 0%, 5%, 12%, 18%, and 28%. These rates are designed to categorize goods and services based on their essentiality and impact on consumers. For example, essential items like basic food grains often fall under the 0% or 5% slabs, making them more affordable. On the other hand, luxury or non-essential items are typically placed in the higher slabs, like 28%, to help with revenue generation and possibly discourage overconsumption. Additionally, there are some specific rates that don't fit neatly into these slabs, like 0.25% and 3%. These are applied to certain goods and services that require a more nuanced approach, perhaps because they are niche or have special considerations. Overall, these varying rates help balance the goals of fiscal revenue, social equity, and economic growth. They also reflect the government's aim to create a fair, transparent, and simple taxation system that supports both consumers and businesses in our broader economic framework. Now, moving on to some important exclusions under the GST framework. One key point to remember is that alcoholic liquor meant for human consumption is not included in the GST regime. This means that alcohol used in beverages like whiskey, vodka, or beer continues to be taxed separately under traditional tax regimes. Similarly, petroleum products such as crude oil, petrol, diesel, aviation turbine fuel, or ATF, and natural gas are also excluded from GST. These commodities are still governed by their previous taxation systems, like VAT and excise duty. The reason for these exclusions is often related to the significant revenue they generate and the complexities involved in their taxation. By keeping these under existing regimes, authorities aim to manage these sectors more effectively. Overall, these exclusions highlight that while GST aims to unify indirect taxation, certain essential and high-revenue goods remain outside its scope for now. This allows us to understand that GST isn't a blanket tax on everything, but rather a comprehensive system that still accommodates specific sectors with unique requirements. So, as we wrap up, I want to highlight that the introduction of GST has truly been a game changer for India's tax system. It brought about some significant positive changes that have had a lasting impact. One of the key achievements is how it simplified the overall tax structure, making it easier for businesses to comply and operate across different states. This has also helped promote a more unified economy, breaking down barriers that used to exist between regions. Of course, no major reform is ever without its challenges. There are still hurdles to overcome, but the overall goal of transforming and modernizing the tax system has been successfully achieved. What's important to remember is that GST was not just a tax reform. It was a step toward a more integrated, efficient economic future for India. And that's a milestone worth recognizing as we look ahead.